Welcome to the Opening Bell Report.
It is Sunday, February 15th, 2026. And I want you to picture a stock chart that looks less like a financial instrument and more like a heart monitor after the patient has, flatlined.
That is a vivid, if slightly morbid way to start our Sunday. But looking at the chart for GCT Semiconductor, ticker GCTS, you are not wrong.
Right. But then you open this analysis report we have in front of us today, and it's describing a defibrillator shock, a massive one.
Massive one.
We are looking at a stock that, as of Friday, was trading at, what, $1.26? And this report, it is modeling a path to upwards of $4.50.
That's 200% upside.
200%.
It's the kind of discrepancy that makes you, stop scrolling.
Yeah.
You rarely see a gap that wide between market price and an analyst target unless something is fundamentally broken or something is fundamentally about to change.
Exactly. And that is the mission for us today. We need to figure out if this is a value trap or, a winning lottery ticket. We aren't giving financial advice, obviously.
There's not.
We are just taking this inflection point thesis from the analysis report and stress testing it. Because, honestly, when I see a company projected to jump 200%, my first instinct isn't buy. It's what's the catch?
And there is a catch. There's always a catch. This is a turnaround story, and turnarounds are notoriously messy.
So let's start with the mess. The report calls 2025 a disaster. How bad was it?
It was grim. 2025 was effectively what they call a kitchen sink year.
Okay, break that down for us. Kitchen sink implies they threw everything out.
Exactly. In corporate finance, when a new management team or a company hitting a wall wants to reset, they take all the pain at once. They write down bad inventory, they kill off failing product lines.
They take all the losses in one go.
All in one go. They lower the bar so low that just stepping over it looks like a huge jump. For GCTS, revenue collapsed to about $3 million.
Wait, hold on. $3 million total. For a publicly traded semiconductor company.
Yeah.
My local coffee shop might do $3 million if they sold enough oat milk lattes.
It is tiny, and that's down from roughly $9 million the year before. The market looked at that $3 million revenue line, looked at the cash burn, and, effectively priced them for bankruptcy. That's why the stock is sitting at $1.26.
Okay, so the market says dead, but the analysts say sleeping giant. Why? What makes them think this thing even has a pulse?
Because while the legacy business, the old 4G stuff, was dying off, the R&D team was finishing the 5G portfolio. The thesis is that the market is currently looking in the rearview mirror, which shows a cliff.
And the analysts are looking through the windshield.
Which they believe shows an open highway.
Okay, so let's talk about that highway. GCT Semiconductor. They're fabless, right? Which sounds like some kind of minimal lifestyle choice, but in the chip world, it means something very specific.
It means they design the brains, but don't build the body. They don't own the factories, or fabs, which is a good thing because fabs cost billions of dollars to build and maintain.
So they just design the circuits.
They design the architecture, the complex circuitry, and then they pay someone else, usually a massive foundry, to actually print the chips for them.
So they're pure intellectual property and design.
Correct. High margin potential, very low asset intensity.
But the chip market is just brutal. You have Qualcomm, MediaTek, these huge players with infinite budgets. If GCTS is a $3 million minnow, why haven't they been eaten alive? Are they trying to get into the iPhone?
No.
Because if they are, we can just wrap this up right now.
No, and that's the critical piece of the puzzle here. If they were trying to get into the Galaxy S26 or the new iPhone, they would lose, period.
Okay.
GCTS plays in the, let's say, unsexy corners of the market, the edge, and industrial IoT.
Unsexy usually translates to profitable if you can own the niche.
Precisely. Their gold mine isn't smartphones. It's something called fixed wireless access, or FWA.
FWA. Okay, we hear that acronym a lot lately. It feels like every single telecom commercial is screaming about 5G home internet.
It is having a huge moment. Think about how you get internet right now. Usually, a guy comes to your house, drills a hole in the wall, pulls a cable from the street.
The Coke or fiber method. The classic, please stay home between 8 a.m. and 4 p.m. method.
Right. FWA just deletes the cable. You get a router that plugs into the wall for power. But for data, it talks directly to a 5G cell tower.
So it's like a super-powered hotspot for your whole house.
For your entire house or office, yeah. Robust enough to run Netflix, Zoom, and your smart fridge all at the same time.
Okay, I've definitely seen T-Mobile and Verizon pushing this hard. But are they using GCTS chips?
The giants use a mix. But the real explosion, the one GCTS is targeting specifically, is SMES, small and medium enterprises.
The coffee shop I mentioned earlier.
Exactly. Or the construction site trailer, the small accounting firm, the pop-up retail store. They need fast internet, like instantly. They don't want to dig up the parking lot to lay fiber.
And they need backup internet.
Crucially, yes. If the cable gets cut, they can't process credit cards.
Yeah.
FWA is the perfect instant-on backup.
So GCTS designs the chips inside those riders.
Yes, and specifically, chips that are optimized for that exact use case. They aren't trying to be everything to everyone like a smartphone chip. They're trying to be the best, most cost-effective solution for a router that sits on a desk.
Okay, I get the product. That makes sense. But let's go back to the numbers because I'm still struggling with the sheer magnitude of this forecast. We established they made about $3.9 million in the last 12 months.
Right.
The report forecasts 2026 revenue at $38.4 million.
That is the number.
That is a 12x increase, a 1,200% jump in 1 year.
It sounds fake, doesn't it?
It sounds like a typo. Or a hallucination. I mean, how do you justify a 1,200% revenue spike without assuming some kind of miracle?
You have to understand the difference between sampling and volume. This is the core of the semiconductor business cycle. In 2025, GCTS was just sending out samples, engineering units.
Which they probably give away or sell at cost, right?
Yeah, often at a loss, yeah. You're courting the customer. You send them the chip, their engineers test it, they break it, they complain, you fix it. That takes like 12 to 18 months. You don't make money on samples, you burn money.
Go.
The whole thesis for 2026, the reason for that 12x jump, is that the courting phase is over. The marriage is signed, the customers, the router makers, are moving to commercial volume.
Ah.
So when a customer switches from buying 10 chips for testing to 10,000 chips for production, the revenue doesn't grow linearly. It step changes. It goes vertical.
So the $38 million isn't about finding new customers. It's about existing customers finally turning on the faucet.
Exactly. It's the backlog converting to cash. It's that inflection point the report talks about.
But are they making money?
Right.
Because, revenue is vanity, profit is sanity. If they sell $38 million worth of chips, but it costs them $50 million to run the company, we still have a huge problem.
A classic line.
Right.
And in this case, sanity is still maybe a year away.
Mm.
Even with $38 million in revenue, the net income is projected to still be negative in 2026.
They're still losing money.
They are. But, and this is key for how stocks work, they are losing less money. The EPS, earnings per share, is moving from negative 77 cents to an estimated negative 23 cents.
The bleeding is slowing down.
Dramatically. And in the stock market, the second derivative, the rate of change, often matters more than the absolute number.
Right.
If you prove you can cover your fixed costs and the gross margins are turning positive, investors will front-run the profitability. They'll buy now before the profit actually hits the books in 2027.
Front-running the profitability. So we're betting that the bleeding stops before the patient dies.
That is the bet. And to be clear, the analysts see that volume production covering the fixed costs pretty soon. Once that happens, every extra dollar of revenue flows pretty directly to the bottom line.
To feel comfortable with that bet, though, I need some validation. I need proof. We can talk about router makers in the abstract, but do we have names? Because if this is just secret customer A, I'm pretty skeptical.
We do have names, and one of them is fascinating because it proves that tech works in probably the worst possible environment you can imagine. Gogo.
The in-flight Wi-Fi people?
The very same. Gogo is upgrading to a 5G air-to-ground network, and GCTS chips were used in the successful tests.
Okay, hold on. Making a 5G connection work while I'm sitting on my couch is one thing. Maintaining a stable 5G connection at 30,000 feet, moving at 500 miles an hour. That seems like a much harder engineering problem.
It's a Doppler effect nightmare. The physics are incredibly difficult. The signal is constantly stretching and compressing because of the speed of the aircraft.
And the GCTS chips handled that.
They did. And that is a massive stamp of approval. It tells every other potential customer, whether they're making industrial robots or smart parking meters, if it works on a jet, it'll work in your vending machine.
It's the cool factor validation. It's like a car company winning Formula One to sell sedans.
It is. And then you have the volume validation. The report mentions partnerships involving Verizon, specifically for Orbic-branded hotspots.
And Verizon doesn't mess around with small batches.
No. If Verizon is involved, even tangentially, through a partner like Orbic, we are talking about scale. If that scales up, that's where your millions and millions of dollars in revenue come from.
So we have the tech validation from GoGo, the Hero application, and the volume channel from the Verizon ecosystem. That makes the $38 million sound a little less like a hallucination.
And more like a plan.
It turns it from a hope into a roadmap. In 2025, the roadmap was blank. Now, they're actual signposts.
That's the idea.
All right, let's do the valuation math, because this is the part where people's ears usually perk up. How do we get to a 200% stock price increase? Is this just hype? Is it just stonks go up?
No, the math here is actually based on something called multiple expansion. It's basically just mean reversion, bringing the valuation back to reality.
Okay, walk us through it.
Right now, based on those terrible numbers from last year, that tiny 3.9 million revenue, the stock is trading at about 18 times its sales.
18 times sales, that sounds expensive.
It is expensive.
Yeah.
If you just looked at that TTM trailing 12 months number, you'd say overvalued. But stock prices are forward-looking. If you believe the 38 million revenue number for 2026, and the stock price stayed exactly where it is today at $1.26, the multiple drops to 1.8 times sales.
Oh, wow. So from 18x to 1.8x.
And 1.8x for a semiconductor company growing at 1,200%. That is dirt cheap. That is bargain basement going out of business sale prices.
So the market has to adjust. It can't stay at 1.8x if the growth is real.
Exactly. The report compares GCTS to its peers, like Sequens or MaxLinear. When those companies are in their growth phases, they typically trade between 3 to 5 times sales.
Okay, so if GCTS gets that normal multiple.
Here's the logic. If GCTS hits 38 million in revenue and you apply a standard 4x or 5x multiple, which is common for these stocks, you get a market cap of around $150 to $190 million.
And what's the market cap today?
Around 72 million.
So that's more than a double right there.
Correct. You take that 150 million market cap, divide it by the number of shares, about 57 million, and you get a share price of roughly $2.63. If they hit the higher end of the estimates, the math pushes the price over $4.
So the math isn't magic. It isn't relying on them inventing cold fusion or something.
Not at all.
It's just assuming the company creates a normal amount of revenue and gets a normal valuation for it.
Exactly. The upside comes from the market realizing, oh, wait, they aren't going bankrupt.
It brings us to the most important part of this deep dive, the bear trap. Why would they go bankrupt? Because we can't ignore the risk here. If the upside is 200%, the downside is usually, well, zero.
Absolutely. And in this case, the bear trap is very real and very dangerous. It all comes down to one phrase: cash is king.
And GCTS doesn't have much of a kingdom.
Not right now. The report is blunt. The company burned through about $27 million last year.
Ouch. That is a serious burn rate.
And based on the last reports, they only had about $1.4 million in cash on hand.
Wait, pause again. Burned 27 million, has 1.4 million in the bank. That math doesn't work. That's insolvency.
Technically, they're running on fumes. This is the race. They need that revenue from GoGo and the router makers to arrive now.
But even if the revenue arrives, invoice terms are what? Net 30? Net 60? They can't pay payroll with invoices.
Exactly. Which brings us to the dirty word that every small cap investor hates: dilution.
Explain that for the folks in the back.
The report mentions an ATM facility that's an at-the-market offering.
Which says convenient, like getting $20 for lunch?
It's convenient for the company, but it can be painful for the shareholder. It allows the company to print new shares and sell them directly into the market to raise cash.
So if I own 1% of the company and they just print more shares...
Your slice of the pie gets smaller. You own less of the company. The report says share dilution is a near certainty. They have to sell stock to keep the lights on until the revenue shows up.
So that $4.50 price target, does that account for the fact that there might be 20% more shares floating around by then?
Ideally, yes. The analysts bake some of that dilution in. But here's the real execution risk. What if the 5G rollout gets delayed again? We saw delays in 2024. What if the customers say, hey, let's push this launch to Q4?
Then they burn cash they don't have.
And they have to print more stock. And the stock price doesn't go to $4. It retests the lows. The report suggests it could drop to 90 cents or worse.
So it really is a race against the clock. Can they ship the chips and get paid before they run out of runway?
That is the fundamental tension of this trade. It's not a safe, steady compounder. It is a binary bet.
Hero or zero.
Exactly. The report characterizes this as a venture capital style trade in public markets.
That's a great description. In venture capital, you expect most of your companies to fail, but you hope one of them goes 10x.
Right. This is a potential hero, but it carries that startup level risk. It absolutely requires a strong stomach for volatility.
So for our listeners who are interested, who like the adrenaline of a turnaround play, we can't just leave them hanging. What is the one signal they need to watch for?
The next earnings call. But don't just look at the headline numbers. You need to listen for one specific phrase: commercial shipments.
Not sampling.
No. We're done with sampling. If they say we are continuing to sample, run. Sampling is death right now. You need to hear commercial shipments and revenue recognition.
That is the starting gun.
That is the signal that the turnaround is real. That confirms the J-curve theory.
Commercial shipments. Got it. We're looking for revenue, not just research.
Precisely. If you hear that, the thesis is active. If you hear delays or continued testing, the risks just went through the roof.
It's a fascinating dynamic. You know, zooming out for a second, it makes me think about the broader ecosystem. We have these giants like Verizon, T-Mobile, AT&T, and they're staking their reputation on 5G home internet.
They are. It's their main growth engine right now.
But they aren't building the silicon themselves. They're relying on these small, agile, slightly desperate players like Semiconductor to make the economics work.
It's true. The big providers need the cost structure that companies like GCTS provide. They can't put a $100 chip in a router they're basically giving away for free. They need the $10 chip from GCTS.
So the giants are standing on the shoulders of, well, not midgets, but very lean, very hungry Davids.
A high-stakes game of Jenga. The giants need the Davids to survive, or the whole architecture gets a lot more expensive for them.
That is a provocative thought. The future of our home internet might actually depend on whether these small companies can keep the lights on for another 6 months.
It very well might.
Well, there you have it. You are now officially the smartest person in the room when it comes to GCT, Semiconductor, and the wild world of 5G turnaround plays.
It was a pleasure to unpack it.
And a huge thank you to you for listening. Keep those eyes peeled for commercial shipments, watch that cash balance, and remember, in the world of microcaps, nothing is guaranteed, but the story is always interesting. We will see you on the next deep dive.
Don't forget to like, share, and subscribe for more.